Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today, Tuesday, May 19, 2015. Inside the numbers tonight, we're going to do the SPY and the E-mini contract. Maybe this could be the calm before the storm. We're going to talk about that concept. Crude oil got whacked. Gold got whacked. The bond market almost got whacked. It didn't get whacked. Then it got whacked. And then the U.S. dollar had a rally today. So we're going to go over all this stuff and some more. And so let's flip over and go right into the daily chart. Well, this is the ES. Let's go over to the E-mini contract. I've got all new numbers. I redid all the calculations. I've got new lines. It's a fresh look. Let's talk about what's going on. So we've had one of these grind higher, and there's a lot of people skeptical. We're climbing the wall of worry. I get all that. The market shouldn't be doing this. It shouldn't be doing that. It doesn't really matter. It's doing what it's doing. And so the question is, are we going to have a pullback, or are we going to have a vacuum to the upside? Now, you got a couple of things going on this week. I think you have some Fed minutes being now released tomorrow. And then I think you have some economic data on Friday of some sort. I don't really pay too much attention to that stuff. I just look at the charts. But just to let you know that these things can light a spark in the market. Now, being that there is a lot of people skeptical, and the cost of protection or to buy, for example, the VIX index via call options is very, very cheap right now. So my guess is that there's a lot of accumulation going on in order to buy protection against A, positions, or B, the market, or both. And if we get a spark to the upside, that could cause a vacuum because you'll get a lot of running to short covering. Okay, you'll get a lot of selling of the VIX call options, and you'll get a lot of selling of the calls that were the selling of the puts that were purchased on individual names or stocks, and that'll cause a vacuum to the upside. Is that going to happen? I don't know. If that's going to happen, it could happen this week. But if we do get a pullback, let's talk about some of these numbers. They're not that deep here. So, I did the calculations 2-3 times, and I keep coming up with the same thing. So, your first target really, aside from some minor downside targets from where we are now, for example, 212 is a target, is a support level, but I'm not going to put that in. It's $1 away. That's nonsense. But your first real level of support should be about 211 to 211 and a quarter. It came in on the number at 211.20. And then from there, 209.74, and then down to 207. And that's all you need to know for now. But I don't expect any big sell-off. In fact, if we do get a pullback for a few days, let's say we get a pullback into the Memorial Day holiday, right? So we get a pullback Wednesday, Thursday, and a flat day Friday. Monday's closed. What happens Tuesday? Tuesday, I think we turn right back around and march back higher. If we go up tomorrow, Thursday, and Friday, Monday's closed, what happens Tuesday? Then I'm more skeptical that the market will actually turn after the Memorial Day holiday. I do think we need one more some kind of correction prior to making new highs. But whether that comes or not is insignificant because it's not like we're waiting to be on the short side. What we're waiting for is any dip to purchase the dip. Why? Because higher prices are coming. You could see 100, 150 handles on the S&P on the upside. I know I've been saying that for a long time, and most people don't believe me, but let's address that for a second. Let's go to the E-mini. What was the high today? The high today was the pop-up. The high today was 21.34. How long have I been saying 21.30 to 21.35? I've been saying it since October, okay? And here we are. And it's not like I just threw it out there saying someday we're going to get to 21.30. I mean, I was pretty vivid. And as we started into this year, I said, I've got this upside unsatisfied target, 21.30, 21.35, 21.34 today. Missed it by a point, okay? So my point to you is that my numbers are not coming out of the blue. They're calculated based on a lot of different factors, and they're not right all the time. Okay, but they're right way more than they're wrong. So the point is when I'm giving you some numbers, you should kind of listen and take heed to them. I've got a lot of emails coming in, kind of looking for I've got people asking me roundabout questions, looking for a turn in the market. They're short, obviously, by the way the questions are coming in. And my response is, why are you short? Who told you to be short? So I just want to flip over to something for a second, okay? Let's go to the weekly chart of the SPY. What is bearish about this chart? Nothing, right? What is bearish about? There's nothing bearish about this chart. In fact, yeah, you need to pull back a little bit here and there, just like some of these red candles here. But that's a weekly chart, right? So this is a 1 week, 1.5 week pullback, or 2 week pullback, 1 week pullback, 1 week pullback, 3 weeks up in a row. Yeah, we're going to get another pullback? Sure we will. But are we going to go down here? No, not right now. Later. I'll tell you when. Okay, but now the path of least resistance is up, so we're buying pullbacks. We're not shorting the market on light volume in an uptrend. When you have moving averages that are parallel to each other in an uptrend, moving from bottom left to upper right, okay, red is 20 period moving average, so 20 week, blue is 50 period or 50 week moving average, and they're parallel, okay? What do you think's going to happen? There's no trouble in this market, real trouble, until the red or the 20 period begins to cross over the blue. Okay, let's take a look at the monthly chart. Okay, what in the world is bearish about this market? You're not bearish. This is not bearish. Okay, right here I'm telling you this market technically is not bearish until you close the month. Okay, if I can get my cursor here, until you close the month at 198. Okay, that's the time when you could say, uh-oh, there's something wrong with the market. Up until that happens, there's nothing wrong. This is a bullish market. Is it going to close below there? Is it going to get bearish? Are we going to see some panic selling this summer or after the summer? Yes. Yes, we will. Okay, but for now, the trend is up. The trend is your friend up until the end. Okay, very, very simple stuff. All right, so back to the daily chart. In a recap, are we going to get a pullback? Yeah. Do I know it's coming tomorrow? No, I don't. I just don't. I've given you the numbers. On the upside, we can get up to 2144 at this point. I'm going to say we've satisfied 2135. So my next target higher is 2144. And if we satisfy that, I'll give you the next upside target from there. On the downside, and that's on the E-mini, on the downside, 211.20 on the SPY, and if you translate that, we're gonna stick with the 2115, 2112, and then 2104, 2105 are the numbers that are very, very important for the E-mini. So in fact, let's put the 2105 in there. Okay, 2105 is important. So 3 levels are extremely important in the E-mini: 2115, 2105, and 2085. Any hourly and or daily closes below those levels, and there's trouble. Anything less than that, meaning we stay above 2115, nothing wrong with the market. There's the story. Let's flip over to gold. Gold got hammered today. I said yesterday we were going to get a pullback, and I thought we would only get about $10 in the price of gold futures, and we got 20. So there could be more downside, and I redid some calculations here as well. And this this purple trend line here that comes in, that comes in at about 1215. Or no, is that 1250? Where is that? No, 1205, pardon me. That was a retrace. That was a Fibonacci retrace from this up move here. And that's why that line was there. So it's no surprise that's where we came into. But I am a little surprised that we didn't stop at 1212, 1215. That was a little surprising. But nevertheless, there could be more downside. So what I'm looking for is, I think you would find very, very good chart support at 1197, which would be another retracement down here at this purple trend line, and you would have the moving averages as a support underneath the number there. So there's your deal in gold. There's nothing telling us a definitive buy is at hand in gold. We've got to see the market show us. So apparently we've made somewhat of a shorter term top here, but there's higher prices coming in gold too, just like the stock market. Make no mistake about it. For example, in July, there's There's certainly between now and July, whether we pull back more or not, there's going to be higher prices coming in gold. There's going to be higher prices coming in the GDX or the gold miners into July and potentially beyond. So while these markets short term may have some turbulence, I do anticipate and expect the market to move higher, stock market and the gold market to move higher over the next couple of months or so. But, in between, we can certainly get some pullbacks and consolidation. So let's go to oil. Good thing we had our lines in the chart. Let's recap what happened in oil. We made the move up here out of this. Let's remove this sphere here because you guys have seen that enough. Okay. Well, I guess we can't remove it. I'll work on that later. There it is. Okay. So we consolidated here. We popped up, and I gave you a bunch of numbers. 2050 was very important. We saw how that was important. We got above it, came right back below it. It was very important. We did it twice. Okay. And the next level of importance, we were looking for 64, but we got to 62.58. That was our upside target. Maximum target was 64. We got to 62.58, but we put that in down here. Don't forget that. We pulled back and we had another level of support at 58.63, and you see how important that is. You see the price beating up against that level. That was enormous support. 1, 2, 3, 4, 5, 6, 7, 8. I'll call that 9 times. Okay, 9 times that level was supported. Broke today. Where did we go? We went right to this next trend line, which was the pivot top after this surge here. Boom, boom, boom. These are 3 soldiers, 3-bar surge right up here. And we had this $57, and we came right into that. I think the low today was 57.09. 57.09, and the price of crude futures, low 57.09. So that obviously was support. Look at all this support here, all this consolidation, these pivot high here, pivot high here. That was obviously going to be support. So what happens from here is we're either going to continue down, and if we do, the next best bet would maybe be all the way down to the 50-period moving average, which would bring us to about $55. I don't know that we get there. We'll see. We'll have some stops along the way because you'll find support at these lows in here. Whoops, I moved my line. Whoa. Okay. You'll find some support down here at the $56 level, but all in all, it's not in an enviable position if you're long, not looking to get long right now. I think there's more downward pressure in the price of crude oil. And what does that tell you? Maybe there's higher prices coming in the dollar. Maybe there's lower prices coming in the price of crude oil. And we'll see what happens from there, but there's no reason to be long crude at this point. Let's go over to the bond market. We're going to look at the 20 to 30-year bond via the TLT. Really whipsaw day today. It was very strange today. Let me show you something, and actually going to give you a little bit of a chart lesson today also. We started down. I'm going to go to the 10-minute. We started down in the morning, popped back up, started down in some economic news, popped back up, looked like we were making a reversal pattern, and then it even looked like we were going to make a retracement of the reversal pattern and then shoot higher, and we rolled over and failed. But look what happened. So if you want to learn Fibonacci retracements, I'm going to show you an interesting one right here. So intraday, you can use these on any time frame whatsoever, 10 minutes or monthly or yearly, quarterly, whatever you want. Okay, so watch how perfectly these hit. So I put a Fibonacci retracement, and we have 0 to 100%. And in the middle, we have 25, we have 38.2, 50%, 61.8, 75. And I know these 25 and 75s are off a little bit from what you're used to seeing, but somebody a long, long time ago adjusted my charts and said, use these, they're more betterer. And I didn't question it. I said, why? And he just said, because that's the way it is. Don't ask questions sometimes. So I didn't. And so that's what I use. And they do seem to work out. See how the price comes into these 25% retracements a lot of times. A lot of times there's a 23 point, what is it, 23? I don't even remember anymore. But it's one a little bit less than this. Anyway, the point is, look, bottom, top. Pivot top. You know this is a pivot top after the next candle or two closes below the this low here. Then it's deemed a pivot top. And so you can draw your line in from low to high, and look what happens. 618 retracement is at 118.78. As we're selling off in this afternoon, what's our low on that candle there? 118.80. So if you have your lines in the chart and you're familiar with Fibonacci retracements and you're comfortable knowing that the market does retrace those numbers, then you can put an order in at 118.78, 118.75, maybe a little below. See what happens. You get a bounce up to 119.40, okay? And by the way, that's an intraday swing trade, or it's not a scalp trade. It's someplace in between. It's a day trade. It's an intraday day trade that if I can find 4, 5, 6 of those during the day, okay, and I've got them in my radar screen, I'm always watching the charts. I see these patterns developing. They're not all at the price levels that I would like to purchase at, so I'm watching them. If I can catch 3, 4, 5, 6 of these a day, and usually you can, and they're good for 30 cents, 40 cents, 50 cents, $1, $2, you know, you don't have to buy big share sizes. You know, you win $200, $300, $400 on 4, 5, 6 trades during the day. You have some swing trades out there. You have some morning scalp trades, very quick scalp trades that you're in for a minute, 10, 20 minutes, 5 minutes, whatever it is. You know, you put together a nice day, 3, 4, 5 days a week, and it's a business. So, you know, just wanted to show you some of the things I look for and how these Fibonacci retracements do work out, whether it's intraday, daily, monthly, weekly, annually. It doesn't matter. Even on a tick chart, a 1-minute tick chart, it doesn't matter. They all work out. So, you know, get familiar with the Fibonacci retracements and learn how to use them. It's very important. I think what I'm going to do is I'm going to put together an extensive lesson on those, and we're just going to focus on learning all the ins and outs, where to pick the pivot points, how to use the smaller and bigger time frames, when to use the certain retracements, when certain retracements will be better than others, when others will hold, what targets are. So I think if I can do that, it'll help everybody out a lot. I think I'm going to write that down, and I'm going to try and do it as soon as possible. So there you have it. Other than that, I think that's all I wanted to cover tonight. I got the bonds, I got the gold, I got the oil, I got stocks. Yeah, we got them all. So let's give it a wrap. I'm David Frost. Hopefully it's been helpful. This is mystrategicforecast.com. Thanks for tuning in, folks. Another episode of Common Sense Market Analysis.